On the corner of Wall and Broad Street, in Lower Manhattan, there is a building with 6 great columns and an enormous flag draped across its front. It looks like a temple, and in a sense, it is. Because behind those columns sits the single most famous marketplace on Earth. A place where more than $40 trillion of the world's companies quietly change hands. But here's the strange thing. Almost nothing you picture actually happens there anymore. The shouting traders, the paper flying, the frantic hand signals, that's mostly theater now. The real action is a silent river of electrons, moving faster than you can blink. So what is the New York Stock Exchange really? It's not where money is made. It's where the world decides what things are worth. This is how it actually works. It started with a tree. In the spring of 1792, the American financial world was tiny, chaotic, and completely unregulated. So on May the 17th, 24 stockbrokers met, by tradition under a buttonwood tree on Wall Street, and signed a single-paragraph pact now called the Buttonwood Agreement. It did 2 simple things. It fixed the commission they would charge, and it promised that these men would trade only with each other. It was essentially a private club, an exclusive handshake between 24 brokers who wanted to bring a little order to the buying and selling of government bonds and the shares of the first banks. That handshake is the seed of everything that followed. Over the next 2 centuries, that little club grew into a formal institution, moved indoors, built the grand columned building, and earned a nickname that stuck, the Big Board. From a tree on a dirt street to the beating heart of global capitalism. But to understand what it does, you first have to understand what a stock exchange actually is. Here is the thing most people get wrong. When you buy a share of a company on the New York Stock Exchange, that money does not go to the company, not a cent of it. The company got its money once, long ago, on the single day it first sold shares to the public, its IPO. After that day, the exchange becomes something else entirely, a secondary market, a place where investors trade those existing shares among themselves. When you buy a share of a 200-year-old corporation today, you are simply buying it from another investor who wants to sell. The company is not even in the room. So if the exchange doesn't fund companies, what is it for? 2 things. First, it provides liquidity, the confidence that whenever you want to sell, a buyer will be there, which is the only reason anyone dares to invest in the first place. And second, moment by moment, through millions of these tiny trades, it does something almost magical. It discovers the price. It takes the collective hopes, fears, and guesses of the entire world and boils them down into a single, constantly updating number, the value of a company right now. So, how is that price actually found? The New York Stock Exchange runs on a model called an auction market, and it works exactly like it sounds. At any moment, for any stock, there is a crowd of buyers, each willing to pay up to a certain price. That's the bid. And a crowd of sellers, each demanding at least a certain price. That's the ask. Picture 2 staircases facing each other. Buyers stacked up on one side bidding, sellers stacked up on the other offering. A trade happens at the exact point where the highest bid meets the lowest ask, where a buyer and a seller finally agree. That meeting point is the price. Do this thousands of times a second across thousands of companies, and you get a live, breathing map of what the world is willing to pay for everything. And crucially, every trade is between 2 investors. The exchange itself isn't betting, it's the referee and the venue, matching the buyers to the sellers and taking a tiny fee for keeping the whole thing fair and orderly. For most of its history, That matching happened in one legendary place, the trading floor. A vast, roaring room where human brokers physically shouted and gestured to buy and sell. And presiding over it was a special breed of trader, once called the specialist, now called the designated market maker. Each major stock is assigned one. Their job is unusual. They are obligated to keep their stock's market orderly. If suddenly everyone wants to sell and no one wants to buy, the designated market maker must step in and buy using their own money to stop the price from falling off a cliff. They are shock absorbers, paid to provide stability when the crowd panics. And it is the designated market maker who runs the two most important moments of every day: the opening auction, which gathers all the overnight orders and sets the first price, and the closing auction, which sets the official price the whole world records. Bracketing it all are the two most famous sounds in finance: the opening bell at 9:30 in the morning and the closing bell at 4, rung, more often than not, by a celebrity or a company celebrating the day it went public. But now for the twist, the thing that makes the modern exchange so strange, that romantic image of the roaring floor. It is today mostly a performance. Over 80% of all trading on the New York Stock Exchange is now purely electronic. Orders matched by computers in millionths of a second in data centers that sit not on Wall Street but across the river in New Jersey. The floor still exists. Traders in colored jackets still stand there, but they are handling a shrinking sliver of the volume. In 2020, during the pandemic, the exchange did something that would once have been unthinkable. It closed the physical floor completely and went 100% electronic, and nothing broke. The market ran perfectly fine without a single human on the floor. So why keep it at all? Because the floor still does three things machines can't quite replace. It runs those delicate opening and closing auctions with a dash of human judgment. It hosts the great ceremony of a company's IPO. And, let's be honest, it gives the world a face to point a camera at. The floor is part machine room, part cathedral, part television studio. Now, the New York Stock Exchange is not alone. It has a great rival, and the difference between them tells you a lot about how markets evolved. The big board is the old world, an auction market with a physical floor and those human designated market makers at its heart. And it has long been home to the giant established blue-chip companies, the banks, the industrial titans. Its rival, NASDAQ, was born in 1971 as something radical, the world's first fully electronic stock market. No floor, no trading temple. Instead of one designated market maker per stock, NASDAQ runs on a network of competing dealers, all quoting prices through a computer system. It became the natural home of technology companies. So the two exchanges are really two philosophies of the same idea. One grew out of a room full of shouting humans and slowly digitized. The other was born inside a computer from the very start. Two roads to the same destination, a fair price, found fast. And here is the fact that surprises almost everyone. The New York Stock Exchange, this symbol of American capitalism, this 200-year-old institution, is itself a private, for-profit business. For most of its life, it was a members-only club, owned by the brokers who traded there. But in 2006, it did the very thing it exists to enable. It went public, selling shares in itself. And then in 2013, it was bought outright. Today, the New York Stock Exchange is owned by a company called Intercontinental Exchange, ICE, a corporation that runs exchanges and data services all over the world. So the great marketplace is now a product, one that earns its money by selling three things: the right to list your company on it, access for traders to plug into it, and increasingly, the most valuable of all, the torrent of market data it produces every second. And there's a beautiful little twist buried inside this. Intercontinental Exchange, the owner of the New York Stock Exchange, is itself a public company, and its own shares are listed and traded on the New York Stock Exchange. The marketplace, quite literally, trades on itself. A machine this powerful needs guardrails because it has broken before, spectacularly. The exchange lived through the great crash of 1929 that ushered in the Depression, the one-day collapse of Black Monday in 1987, and the financial crisis of 2008. Out of that 1987 panic came one of its most important safety features, the circuit breaker. If the market falls too fast in a single day, 7%, then 13, then 20, trading is automatically halted for minutes or for the rest of the day to force everyone to stop, breathe, and think before the fear feeds on itself. Overseeing all of it is a government referee, the Securities and Exchange Commission, born from the ashes of 1929 to police the markets and protect ordinary investors. And the exchange keeps evolving. It is now moving toward around-the-clock trading, so that the price of the world's companies never stops updating. A market that one day soon may quite literally never sleep. So, what is the New York Stock Exchange in the end? It is a 230-year-old handshake that grew into a $40 trillion machine. It does not make money. It discovers what money thinks things are worth, and it does so millions of times a second. Its famous floor is now half machine room, half theater, a stage kept lit above a silent river of electrons. It is a marketplace so essential that it became a company, and so self-referential that it trades on itself. Every weekday at 9:30, a bell rings, and the largest continuous act of collective guessing in human history begins again. Billions of people, through millions of trades, deciding together what the future is worth. Not a temple of money, a temple of price.